Imagine a world where you are just in your office doing the work that you enjoy, not stressing out, but just looking at the charts. You've worked every single day to this task. You've done the work, the journaling, the passive work, the work that you didn't want to do. But now you can sit back, relax, and you can just start to watch the money roll into your account. Now, this doesn't sound like a dream where you put in the work and you make the money you deserve. This is the reality. And this is what we are going to teach today in our video.
It is TWT, and today we are going to be discussing some key vital things to making you more of a profitable trader. Now, you may be wondering, what am I going to teach today? Well, today we're going to be discussing something called daily and time cycles. Now, why is this an important subject? Because this specific area of trading is what's going to help elevate you from just looking at the charts on a specific time frame or specific day can determine the type of trade you can take. What I'm going to discuss with you today is something very interesting, and these are observations that I have made where I'm going to teach you what the idea or theory is first, and then show you in the charts exactly where this has worked. Now, this is not just something that has been shown in hindsight because you guys can do the work outside of this video. If you guys put in the hours, you put in the time, you will find these exact opportunities happening week after week, month after month. So, we will begin with showing you the chart of the GBP USD. This is the pound against the dollar. This is what's currently happening in live trading right now. But if we move over to the side here, these are the time cycles that I am referring to. So, what we tend to see on a Monday to sort of a Friday to approximately 6 day chart is approximately this. What this essentially is showing you is the market will tend to have a high on a Monday, and it will tend to start to fall down towards the Tuesday to the Wednesday, making the ultimate low of the week. By Thursday, we see some consolidation within this region, and we see an explosion within the Friday towards that Monday. Now, some of the key factors that can actually deliver some of these Friday explosions is FOMC, the build up to FOMC, and this tends to be the build up tends to be this consolidation on the Thursday because people are uncertain of where the market will go to. And so when the market comes down here, people thinking let's start taking shorts, and people think by this point, we should be now taking positions where the market will now begin to do this. But as a trader, we know that when the market makes a low like this tends to be liquidating previous lows such as this or even higher time frames where we would observe it more onto the left hand side of the chart. And so a lot of retail traders would think that this is going to now indicate a lower move. However, this is when the reversals begin to happen. This is where a news article such as FOMC would then create and generate that explosion to the upside. And we tend to see this continue towards the Monday. So, why do these lows begin to happen? Well, on Mondays tends to be the highs, which is generally generated through these previous movements, and price begins to start to shrink down lower because Tuesdays and Wednesdays tend to be lower liquidity days, and it tends to sort of react off the Monday highs, meaning people start to anticipate when Monday makes a high, the market will start to drive lower to try and indicate that there's going to be opportunities for it to now drop lower, when in reality it's tending to actually give us opportunities to actually enter by the Wednesday so that we can actually take these runs to the highs. So what would we do in these situations? Well, in this situation, we're assuming that we're in a bullish narrative, which means that if we're in a bullish narrative, the market wants to run higher. And so when the market begins to come to these lows on the Wednesday, what we would tend to do is we want to find an opportunity like on the Thursday or even on the Friday where we can begin to target these Monday highs again, and we can have our stop losses around a reasonable level that relates to our risk to return ratio. So why would we do that? Because we know that if the market is retracing around here, we can enter and we can observe the reap of benefits up here. So why is timing the market and timing the market important? Well, why I would discuss these specific narratives is because if we were to remove this black box, I know I've kind of revealed the surprise here, but if it actually lets me move, this is a bit of a strange one. I don't know what's going on. Here we are. This can mean two things. Having experience and holding for a long time is not just about entering and when you are told. Because if I told you that you could see the highs here and you could enter, you would actually be going into a loss maker right now. Would that be correct? Yes. But also it depends on the amount of risk you're willing to put into your trade as well. If you're risking a lot, then ultimately you will be losing a lot. But if you risk a reasonable amount, you will be trading a reasonable amount and you won't be making a huge loss. It depends on the type of strategies you tend to take. Now, this is more tailored towards a swing trader. So, I'm not telling you that you should wait till specifically Wednesday or Tuesday to actually take your trades. I'm telling you to be patient. When you see a high like this made, don't just enter straight away. I'm telling you to be patient, watch what the market does, and tend to see how news can react and deliver these opportunities to enter in a better position so that you can reap not only better reward, but you can also improve your own psychology where you are being more patient within the markets, letting the markets give you an opportunity to execute your strategy in a much more effective method. So let's remove this now. When I say this is literally not entering at random points, right? We are trying to show you that through backtesting, we will be able to show you that this happens on a weekly basis. So, as promised, let's have a look at this. So this was the week, a couple of weeks ago, around April, so not too long ago, about a month ago, where Monday made a high, right? You can see this is the Monday highs. By Tuesday, we can see that it begins to start to shrink lower and lower, reaching a certain point where we get this liquidity by here. Market makes the low by Wednesday. Thursday, we see an explosion upwards. Friday begins to come down low here and explodes back up by the Monday again. Now, had you entered around here, you would have ultimately been stopped out and lose a lot of money. However, had you waited till Wednesday or Tuesday, you could have entered around here, for example, had your stop losses around here, because this was where the liquidity was liquidated, and have targets set up here. That is with a 150 pip take profit. If I took that take profit, I would be done for the month, right? It's about being patient and knowing when to enter. We don't need to trade and get these ultimate highs. We want to trade to take consistent profits. And that is exactly what I'm trying to demonstrate here. Now, in the current narrative of things, we know that GU was being bullish. So when you see these sort of retracements, you want to take these bullish long trades. Now guys, if you enjoyed this kind of video, I hope you enjoyed. I'm going to do more videos where I'm going to show you the kind of illustrations of what the theory and concepts are and show you in backtesting where you can make these profits. Alright guys, hope you enjoyed. Please like, subscribe, and also the Discord is in the description down below. Please check it out. Alright, peace.